Welcome to the Coverage and Coffee podcast. My name is Caspar Harsey,
And I'm Mo Mirzan.
and today we're talking parametric insurance. So last time we were talking about ENS, which was a follow-up conversation that we had around NatCat, a natural catastrophe that is. And it kind of got us thinking in terms of what other solutions really exist out there. I think the name of this podcast is going to be something along the lines of climate and parametric, and they go in hand in hand quite well.
Yeah, I mean, I don't think by definition, but just as a function of how parametric has been used in the market and how we've seen it really be used so far.
Yeah, no. So when it comes to, I'll take it one step back and then I'll kind of explain what parametric is. But when it comes to climate change, obviously that's a very prudent conversational topic in a lot of industries. Insurance is no exception to that. But when we're talking about climate change in the lens of insurance, it's typically done in a format of protection gaps. So protection gaps refer to what do you have in terms of assets and what can be insured of those assets. It's used in slightly different variations. You'll sometimes see articles or reports. Some of the ones that we're going to reference today will talk about specific events and say how much damage was there and how much was insured. And they'll call that the difference between those two as the protection gap. But it can also refer to the act of getting insurance, right? So you could really get anything insured, but can you get something insured for a rational price is a part of that protection gap conversation as well, right? Just because it exists doesn't mean it's readily available.
Yeah, and just following on from, I believe, our previous episode, where we talked about the markets of Florida hurricane risk, as well as California and wildfire risk. Those are two markets where we've seen the excess and surplus market really step in to fill the gaps left by players such as your State Farm and your Allstate, as they've looked to leave.
Yeah, and when insurers tend to leave an industry, it creates that protection gap. So the thing that we're talking about today, one of the innovative solutions, I'm not actually sure how old it is. I think I have a feeling it's a little bit like ENS, like it has existed, but in terms of its application, obviously it's growing a lot more as the damages and the risk of climate change get ever larger. But what we're going to be talking about is parametric insurance, which is fundamentally different from traditional insurance.
Yeah, I think it's actually really quite cool. Mostly because I suppose, compared to Casper, I've had more of a finance background. And obviously in financial markets, you have contracts such as puts and options that allow you to buy or sell at a particular price when a certain condition is met. And when you really boil it down, that's essentially what a parametric insurance contract is.
Yeah, so parametric insurance, unlike traditional insurance, which is claims-based, so that means that there is a underlying insured value, there's something, an asset that is being insured, or there's a potential damage that has a monetary specific figure, goes through a claims process. And that's typically the part that most people don't like about insurance, right? You're like paying for insurance. Why does it take so long for me to get my money? My house is burnt down. It is burnt down, right? Like, why are we going through this? There's fraud, there's all these different situations. So you have a claims process with traditional insurance, and that is where they actually look at what is the actual damage that has occurred and what do we have to pay out for that. But with parametric, what you have is you have event-based insurance, right? So this is kind of what you were hinting towards. It is, I think, even just like not just like it is kind of more like a financial derivative, but it quite literally is a financial derivative in the sense that the moment an event occurs, right? So if we go back to that house fire, the moment your house is on fire, you will be paid out.
Yeah, and I think that inherently is a much more attractive sort of proposition to a lot of people who need that money immediately just to keep their business going or, keep a roof over their heads in the short-term future. And for people who generally just can't wait for that long and arduous claims process to occur.
Yeah, so it's not really the best example I provided because I don't think you can get parametric house fire insurance actually.
Yeah.
But the kind of the thing is that when you say something is event based, it feels like, okay, well, now it's even more rampant for fraud, right? You're talking about, all I have to do is I have to call up. I'm going to continue with the house fire example. I know I said it. I don't
Just
think
do
it
a
exists.
farm. Just do a different one.
No, I'll transition into that, but because it's not like you can just call up your insurer and you can be like, hey, a fire has occurred, right? And that's actually one of the reasons why house fires can't be parametric, is because you need some sort of confirmation of an event occurring, right? That doesn't involve a claims process being triggered, right? Because when you have a house fire, they'll send someone to your property, they'll assess the damages, there's a police report, there's a firefighter's report. There's all these things that need to be gone through to confirm, yes, there was a fire. Yes, it wasn't the insured's fault. And yes, the things that he said burnt down, right? But with parametric, and the reason why you brought up farms is because typically nowadays, I do think parametric is going to change over the coming years, but typically nowadays it's weather related.
I think weather and perhaps more importantly, agriculture related. But essentially what happens is that you need this third party arbiter of truth to essentially, be a trusted source of verifiable information. So with your typical parametric insurance contract, which might be something that perhaps insures against hurricane risk, the arbiter of truth will use a metric, hence the name parametric, such as wind speed, in order to determine whether this contract will pay out or not.
Yeah, I mean, I hate to call you out, but yes, it is used a lot in agriculture, but it is still weather-based parametric for agricultural purposes.
Yeah.
So the example that he's referring to, and this is actually, it's happening in a lot of different places for slightly different events. I've seen some articles related to parametric in India related to flooding, right? So, flooding occurs near a river. The farms that are near a river get completely destroyed, and all that potential income, all that potential food is lost, right? So then the parametric, rather than having to calculate, okay, well, how good was the yield this year, right? Was it actually a good year, and we were going to have above average year? Because all of a sudden that claims process in terms of, okay, how many seeds did you actually plant? How many man hours went into this? Figuring out the claim for an agricultural flood event is incredibly difficult, right? Because there's all these different factors that can go into it, right? We set this policy last year, but the price of wheat has actually skyrocketed. So, what value are we actually going to use here? Then another example that gets used a lot is in Jamaica, where they kind of aggregated different farms together for a rain-based insurance, right? In the sense that if we don't get enough rain, we will not have any yield, right? So then the arbiter of truth in this case, once again, it's weather stations, and they say, okay, well, we had, a good 25 millimeters of rain per month on average, no event occurred. But then the parametric policy would say, okay, if for the period between April and August, the average rain was less than 5 millimeters, we know that you're not going to have any yield from your farms. Your crops could not grow, or they could not grow to a point where we can actually turn a profit, or not enough grew, or you had to spend a bunch of money watering your plants. So then the parametric event will say, okay, well, in August, if this arbiter of truth states that we had less than 5 millimeters per month on average for the last 4 months, then on a specific date, you will be paid out a certain amount of money predetermined ahead of time, right?
Yeah, I think fundamentally the difference between parametric, at least in terms of how they're set up, and your more typical insurance coverage, is that it really shifts the burden of calculating, how much a certain event might cost you, and whether you can, sustain your operations with that event occurring. It shifts that whole calculation and that complicated matrix from the person insuring the business to the person getting their business insured.
Yeah. So in the Jamaica case, right? It's not so much because it kind of, when we start talking about this, it very quickly starts to feel a little bit like business interruption, like we talked about a couple of podcasts ago, right? So business interruption insurance is a claims-based thing, but it imagines, let's say you have a cafe and it burns and it takes you 2 months to rebuild the cafe to be able to start getting clients again. The business interruption coverage of that is how much money were you supposed to make in those 2 months that you were going to be operational, but you now weren't. And then it indemnifies you and pays you out the amount that you would have made in that period, right? Parametric is slightly different because it's supplementary, right? It's not one of those, these farms likely have property insurance. They likely have other types of insurance. But it's a little bit in the mindset of, okay, what were the expenditures, right? Like all that money that we were supposed to make from this month's yield was supposed to be used on buying new seeds, on buying fertilizer, on these kinds of things, right? Agriculture is not a very, high profit turning industry, right? It's a very high turnover, low profit margin type industry. So if you lose 1 year of yield, it could actually be detrimental to your entire business, right? So the parametric payout is then kind of calculated based on what's it going to take for you to continue next year, right? But it's a little bit different because it is supplementary. It is case by case, right? This isn't a very standardized thing, right? So there may be situations where you think, okay, I'm going to go get parametric insurance. You look at what's in the market and you realize, well, this doesn't really make all that much sense to me. But then in other cases, you think, okay, well, this does actually make sense to me, right? In this specific scenario, it does actually make sense. Let me get this. I know that we're going to have one of these events. I know that we're going to have a bad year. I want to be protected against a bad year, right?
Yeah, and I think that might be why I find it quite exciting, because while the scope of where it's been used thus far has, like Casper said, been mostly supplementary and also by and large restricted to weather-related events, mostly for agricultural businesses, the potential for parametric across multiple different business lines and for multiple different sort of use cases are, crazy to sort of think about.
Yeah, I mean, I know we have a specific example that we want to talk about, but one of my favorite things, I mean, we both learned about parametric. I'd heard about it when I worked, but I had never really come across it. When you and I first went to a conference and people were talking about parametric, I remember that right afterwards, you and I, completely unrelated to what we do on a day-to-day basis, completely before the podcast, just started theorizing potential ways of where parametric could insert, right? Because it really, if you can get an arbiter of truth, and one of the things about insurance, right, you can get anything insured, right? If you can find demand for a certain insurance product, there will be capacity for it. Now, will there be a good price for that capacity? Who knows? But in terms of like theorizing where something like an event-based insurance could come in, there are just so many different scenarios.
Yeah. No, I mean, the possibilities are really sort of limitless. But I think, and this references back to a more recent discussion we've had about the whole parametric topic. I think one of the huge benefits about having insurance in most regulatory regimes is tax efficiency. Now, as we've sort of previously discussed, parametrics might blur the lines between being an insurance contract and a financial derivative, where obviously you wouldn't have the same level of tax efficiency.
Yeah, just to expand on that, I fail to expand on some insurance things. He fails to expand on some financial things. But a lot of the times when I talk to people who know a little bit about finance, they know a little bit about insurance, they'll quickly chime in and be like, okay, well, why am I paying 5% of our revenue, of our profit in insurance? I don't know what the exact figure is, but you're paying some sort of amount to insurance. And then next year you got to pay the same amount, even if nothing occurs. Why am I not just putting that into like an index fund or something and then watching this portfolio grow? And then when a rainy day occurs, I can use it, right? A, it may not grow fast enough for the event occurring, but B, if you have a claims-based event that occurs, right? Claims insurance, traditional insurance, your house burns down and you get paid out $2.5 million to fix your house worth $2.5 million. Guess what? You're not actually getting insured on that, taxed on that $2.5 million. Furthermore, the 5% that you're paying for your premium, that's a taxable business expense. That is a cost of operating. So that's kind of the benefit of using, from a financial perspective, of using insurance rather than trying to, hedge your own potential risks in your own fund.
I think by taxable business event, you mean a sort of a business expense that you can then sort of report on your tax return?
Yeah. And that's where parametric starts to blur the lines a little bit, right? Because like we said in the start, it is more like a financial derivative. And depending on how far you want to take that little exercise I prompted in terms of what could an event-based insurance look like, it does slowly start to sound a little bit like gambling, right? In the sense that, like, let's take the weather scenarios, these, drastic, important situations, right? I heard a conversation once of someone talking about, what if you went to a store, you specifically went to Whole Foods for a specific item they have on their shelves, and you went there and they don't have it. Technically, with like these, systems in terms of inventory management systems, you could have an arbiter of truth to say that it's not there. And when the guy shows up, he now has a parametric event occur, right? But then you take it to completely different scenarios, right? We've talked about this before, but you talk about like polymarket, right? You're like, oh, some event is going to occur on a certain day, and I'm going to get a payout.
The general sort of spot betting market. I mean, sorry, not spot, but prop betting market.
Yeah, and I don't think, I don't know any scenario right now where parametric is used that exact way. I wouldn't be surprised if there are parametric policies out there for events that could never occur, right? I mean, we talked about the mad cow disease with the yak in Mongolia, right? That was later found out that they couldn't occur, that wouldn't really occur. That was a traditional piece of insurance. I'm not surprised if there are people paying for parametric insurance where the chance of something occurring is so minimal that these insurance companies are like, yeah, I mean, like I said, if there's demand for a product, someone will create that insurance product.
Yeah, no, I think another example where these lines might be, shown to be equally as blurred is, let's say you have a business that operates well, but it depends on a certain administration to be in office. And if, perhaps, okay, let's take, Biden and Trump. So at the previous election, say your business does well in the Biden administration, but, you project that you may not fare so well in a Trump administration.
Yeah, I mean,
could you theoretically take out a parametric insurance contract for political risk against the possibility of Trump getting into office?
Yeah, I mean, there already is like political risk insurance. So the idea of there being parametric political risk insurance doesn't sound too crazy, right? I mean, if we just go on an example where you could actually get an existing type of parametric and this hypothetical one, a wind farm in the US, right? Maybe during the Biden administration, you were only able to be in operation because of government subsidies, right? It is one of those industries that does, require some sort of support, at least for the infrastructure piece of things, right? And then or you suspect that if Trump were to win, I'm going to lose those subsidies. So you get parametric insurance on that. But a wind farm can already get parametric insurance on a cyclone event on their wind farm, right? If it hits a certain amount, we know that we're going to need money quick and we're going to need money fast because we have energy contracts. We have these things. We need to fix the situation as fast as possible. I will get normal property to wait for the full thing, but I need a little bit of money just to do spot fixes, things like that. I'll get parametric for a cyclone event on our location, right? It's not too crazy to think that we combined another traditional insurance like political risk with parametric that's already been combined with property. It's not too crazy to think about.
Yeah, no, I think it's somewhat of a, I mean, I say unexplored market, but it is a hugely, growing market even these past couple of years. But I think we will see a lot more regulatory clarity, maybe not strictly in this administration, but perhaps in the next, about exactly where things like parametric insurance lie, when you're concerned about tax efficiency, when you're concerned about maybe even, regulatory frameworks regarding on how you're allowed to operate your business, whether it falls under, the necessary insurance that you need to provide in order to run your business.
Yeah, I mean, the other day we talked about a scenario. One thing about traditional claims-based insurance, if your house does burn down, it's $2.5 million, you get that payout. You have to spend the $2.5 million fixing your house, right? Because it was paid based on the damages that you accrued, and it was paid to fix the damages that you accrued, right? What we couldn't quite figure out while researching was the same scenario for parametric, right? Like, let's say you are a farmer, you had bad rain, you're sick and tired of this cycle. You're kind of done with it, and you realize, oh, maybe you're in California, right? And you're making some unprofitable product at this point. You're doing wheat, right? When everyone's switching to almonds.
What's that crop that everyone farms in California that takes a ton of water and like is kind of useless? Is it almonds?
Almonds. Yeah. But they make a lot of money from almonds.
Yeah.
So let's say that you're doing wheat, you have a really bad year, you get your parametric payout, and you actually decide, you know what, I've had this guy offering to buy my farm. He's going to switch it to an almond farm anyway, so it doesn't matter that I had a bad year. I'm going to take the parametric payout and I'm going to sell my farm and I'm going to have a fantastic retirement. We couldn't quite figure out whether parametric payouts had to be spent a certain way like traditional insurance had to.
Yeah, I think after that discussion we had, we were kind of leaning towards you probably can spend it how you want.
Yeah.
Simply because, with typical insurance products, there'll be a period where the two parties will be in communication after the event occurs and obviously throughout the claims process. And, for several, whatever period afterward, just to make sure that everything is finalized the way it should be. In Parametric, as soon as that pays out, as soon as that contract pays out, that's kind of it. Contact and the relationship between the insuring party and the insured party ceases.
Yeah. And I actually, I think that a pretty good transition here is thinking about, okay, how does this actually come into people's lives on a day-to-day basis, right? We've talked about these companies, we've talked about these hypothetical situations, and how does this payout actually work? I think we actually do have the answer now that I think about it, because the way that it impacts most people is also weather-related. It is rain insurance for events, right? It is, you can actually, as a personal person, you can go and say,
a personal person is crazy.
Well, yeah, okay. Well, rather than a company, right? So let's say you're going to a festival, the festival probably has rain insurance because they're going to make less business, but you actually can go out there and get rain insurance yourself to say, I'm not going to go to this event if there is rain, and they're not going to refund me because there's rain, but I can get insurance that where I'll pay a premium leading up to that event, and I'll get a payout if I go to that event, if I don't end up going to that event. And if I do end up going to that event, they get my premium, right? But the thing is, when they pay out that claim, let's say it is raining, you're going to Glastonbury, it ends up raining, you have this rain insurance, you're not going to Glastonbury anymore. That money, you don't have to spend that on next year's Glastonbury ticket. They just paid you out to indemnify you for the loss that you had in this event, right? In you not going to this event. So I think actually you can end up spending parametric on anything you want.
Yeah, I think, to take that sort of example one step further, we might eventually, not to stray back into hypotheticals and all that, but it's not that crazy to think of a world where you could, potentially take parametric insurance out against even particular headliners not confirming or not showing up. And therefore sort of kind of diminishing your overall experience or your expectation of what the event would have been.
Yeah, no, that's actually a really good point. I think that eventually we're going to see some more, I don't want to use the term like outlandish, but a little bit more bespoke parametric insurance. We were talking about this the other day, and now I feel like I've said we've been talking about this the other day. But
we talk a lot.
But guess what? We talk a lot, and guess what? We actually plan what we're talking about to a little bit of a degree. But I do think that I've completely lost my train of thought. Oh my God.
Okay, let me try to jog it. Glastonbury, headliners, insuring against headliners not appearing, nothing.
Yeah, I completely lost my train of thought right there.
But I can kind of pick it up here, but I think where you see these broad concepts and perhaps newer parts of the insurance industry slowly start to appear in your regular person's day-to-day life. I think you start to see these things in things like extended warranty, in travel insurance, right? when you're prompted at checkout for whatever flight you're taking, there's typically a page where they're like, hey, if for whatever reason you can't make this flight, or if something goes wrong, do you want to get insurance for it? But I mean, you could start to see this happening for festivals and stuff like that, right? Like when you check out, you'd imagine in a format not dissimilar to how you see Klarna and all these buy now, pay later things come up and be prompted. Maybe the page after that, you'll start to see, hey, if this happens, you'll get this payout. You just pay this extra. And, because it is a relatively easy calculation for the party that's, providing the insurance, these are the kind of things that, you'd be able to receive a sort of instant quote for.
Yeah. I mean, that is traditional insurance. That is embedded insurance, I think is what it's called as well. I remember I went to a conference in Denmark, actually, where the head of Uber's insurance was there. And what was really interesting was that they partnered, I want to say Allianz, they partnered with a large insurance company.
I feel like it's Aviva. I feel like I've seen Aviva and Uber.
Could be Aviva, but they're not actually insuring the people who take an Uber ride. That is included, but they are insuring their drivers. So their drivers sign up and they say that one of the parts of being an Uber driver is that you have insurance because they're contractors. You can't use Uber's insurance. And this really blurs the line because like now we're providing with you and they're providing the option to take it out of your payouts. That's a completely different topic, but there is a lot of different types of embedded insurance. Wait, I thought about what I was going to say though. I thought about it. We were talking about this idea of like a third party arbiter of truth, right? And one of the problems with personal lines and parametric is the fact that unless it's weather related, there is no third party arbiter of truth. And I brought up the fact that everyone has a smartphone on them and everyone's smartphone is saying something about something, right? Like if we go back to the hypothetical I said before about going to the store. You may have just heard from a friend that, oh, this store doesn't have that. Let me quickly get parametric insurance on this. But then your phone could say that you actually walked there. You were in the store. You noticed it wasn't there, right? You also probably couldn't get this type of insurance right before you go to the store. It'd have to be some sort of perpetual for a specific good that you need. Maybe it's medication, right? If you go to the pharmacy and that pharmacy doesn't have what you need, you're going to be inconvenienced, some sort of parametric insurance to go on that. But I do think we need to slowly transition because there were some other things that I wanted to talk about today. Because one of the big things that we have talked about last time, the time before that, even today in terms of weather, is climate change, right? And insurance, like I said in the start, tackles climate change in the lens of a protection gap, right? And it either does that indirectly in terms of rain is not as predictable and sporadic, and it's more sporadic. So there's that. That's how one way that parametric can come in and help. Or it's direct in terms of there's more extreme events, right? But there's no specific insurance for climate, right? It's not like we can say, oh, my business is doing worse because, it's getting warmer in the world. There's no one to blame, right? Insurance needs something to blame. The event in parametric, the fire in a claims-based, there needs to be some sort of where was this risk event caused from, right? But what's really interesting is, and I think I told you this, I worked in environmental insurance. And when you hear something like environmental insurance, what do you think?
How, natural disaster. Wait, was it NatCat or just general environment? Yeah. Okay. Let me think. I want to say, insurance policies related to no party being at fault.
No. So I'll give a little bit of a further clue. I don't think you're going to get this.
Oh, okay.
But the two people, or the two parties that I saw at least, and from my research since saw, who get this most is contractors. So contractors, environmental. I'm not going to say what type of, there is a word there. And then municipalities, like government bodies, get these types of insurance.
So that's an extra hint, is it?
Yes, that is an extra hint.
Okay. Personal injury?
There are other types. It is liability. I'll give you that. So there are other types. There's also premises environmental, but it is typically liability. The most common scenario that I saw was a contractor. Let's say you bring a contractor on your site and they mess up the land by like spilling oil or whatever the hell in doing something, right? Like you get a guy in to fix your washing machine, and he completely ruins the rest of your house, bringing in the new washing machine or whatever. That's one type of environmental. The other type of environmental is spillage, right? So you have a sewer tank on your property, right? And it slowly is dripping. So there's two types. There's instant event-based insurance, and then there's gradual environmental-based insurance.
Yeah, I think I remember talking. Yeah.
Yeah, so you have a storage tank on your property, and it'll like spill, and then that like leaks into your neighbor's yard, and their garden is dying, and maybe it leaks into a river and it starts killing animals. That's what environmental insurance really insures. The municipal example is actually quite interesting in the sense that think about a dam, right? Or just like something to slow the flow of a river, right? It's sitting here, there's water coming, sometimes it spills over. What happens in this, I'm actually going to point it to the camera. What happens when the water comes over is that sediment builds up here at the bottom of the dam, right? Now, this is terrible for podcasting because I'm literally showing, but imagine a dam, and at the bottom of the dam.
No. We'll have Harsh draw a beautifully detailed diagram.
Yeah, it'll be on the screen. But sediment builds at the bottom of that dam, and then one day you have a flood event, and all that sediment gets rushed up and spread across in other areas, right? So when you have a flood, yes, there's water in your house, but there's all this stuff that was in the water is also in your house, right? And now all of a sudden, the municipal is liable for cleaning up this could be potentially hazardous material, because those hazardous minerals, they tend to build up, and then all of a sudden you have a compounding issue that it gets worse and worse. But environmental insurance has nothing to do with climate. It does have to do with damaging environment, but it doesn't have to do it in the sense that someone cuts down a tree and they weren't supposed to cut down that tree. It has to do with spilling and like mistakes, really, and how that impacts local insurance. It's very specific.
Yeah, I mean it's almost a bit of a misnomer within the industry, I suppose.
But it's because the reason why it really exists is if you have a storage tank on your property and it spills and it damages your property insurance will come in, right? But if you're constantly opening and closing this, it's now a part of your operation, so it needs some sort of liability insurance. But if it then spills off your property, it starts affecting someone else's property. Yes, typically, there are some deals with property dealing with other properties, but they very often exclude these kinds of spilling events because that should fall under your liability. You're dealing with this every day. It's a part of your business to have the storage tank there. So then someone thought, okay, we need to find a specific policy for these cases for the guys who don't want to pay extra to always have it included, and the guys who do want to pay extra because they have this risk. So yeah, environmental insurance has very little to do with environmental damage or damage from the environment, like you might think with NatCat. It doesn't tackle climate change. It tackles a very, very specific subsegment of risk.
Interesting. I mean, yeah, super interesting sort of segue, but
that was the last kind of thing. We are kind of hitting time here a little bit.
Oh gosh, I don't know if we have time for this, but do you think we should delve into maybe the FEMA stuff? Because I thought that was pretty cool, but
bring it.
You might have to.
Oh, I will have to bring it.
Yeah.
We actually brought this up last time or the time before that, but the National Flood Insurance Program in the US, they have this National Flood Insurance Program. One of the problems that we were talking about the other day was that because the government is, they didn't agree on a budget, there's actually no money for this flood insurance program. I haven't actually seen any articles following that in terms of whether it's impacting people's ability to buy, rent, or whatever. But it looks like there's a bipartisan.
Wow. In this day and age.
Yeah.
My God.
A bipartisan measure trying to allow FEMA to focus and provide more specific supports. Typically, I think I brought this up, but FEMA's primary role is to coordinate, not actually provide support directly. But it looks like they're trying to kind of fix this issue with the National Flood Insurance Program simultaneously trying to transform FEMA a little bit. And one of the levers they're looking at is using parametric insurance for these large flood events, right? Because FEMA only comes in on these flood events if they are quite large, right?
Wait, is that what it says? I'm pretty sure it was mostly about the fact that FEMA is looking to be restructured from focusing on all NatCat to more specific large-scale NatCat. And so, with that gap in terms of, coordination and organization of the relief efforts, you'll start to see a lot more stress placed on local and sort of municipal bodies to cover where FEMA doesn't really step in. And so I believe the article from the Insurance Journal opines that, perhaps we'll see that parametric insurance be used to provide a bit of a stopgap and a bit of a, short-term coverage to those municipal and local governments, if this bill does pass. I believe it's just come out of the House, but we'll see if it does eventually pass.
Yeah, no, you are right about that. It is focusing on more severe events. I just kind of tunnel visioned on the parametric piece of this article. But yeah, it is trying to switch to a more specific or more large scale events. The problem with that decision is that it would probably, it says here that the proposed FEMA changes would have consumed 21% of the state's rainy day fund in Florida when it came to Ian and Nicole. So what FEMA ended up spending would have taken a huge chunk out of Florida's actual money to be able to do anything. So yeah, they are looking at whether a parametric policy paired with robust risk mitigation and insurance strategy, which, yeah, I'll touch on that in a second, can, support and help alleviate this financial burden that ends up being taken on federal, state, and local authorities. I mean, it sounds like they're just kind of shifting the burden, but yeah. Any thoughts?
I mean, I think they are shifting the burden, but, if this thing does pass, we won't. I mean, obviously, the local and municipal governments don't really have much in terms of agency as to whether it will. But, perhaps we will see more alternate forms of insurance capacity and abilities to sort of mitigate and deal with these disasters start to crop up out of necessity. But again, with a lot of things in insurance, it's all well and good until these things really get put to the test.
Yeah, I mean, and also, like I said, you can get any insurance product, but for a given price, right? So we'll see. I mean, this might be the kind of thing that, yes, it won't take the state's rainy day fund, but it may take a lot of FEMA's rainy day fund in terms of we need to constantly be paying for this insurance on behalf of the states that maybe may or may not be triggered. But on that note, we will kind of wrap this up. It's getting a little bit long. I will kind of finish this off with a single statement, which is that dealing with, like, when you're considering insurance and you're talking about climate, it is a two-pronged approach, right? So we can get coverage for floods, but we can also implement better waterproofing in your walls and in your doors to reduce the damage that comes from a flood. I think that these extreme weather events are just going to become more commonplace. Insurance is not the silver bullet to be able to fix this. And neither is, there's always going to be risk mitigation, but at some point it does become risk preparation, right? And on that note, I want to say thank you for listening today. My name is Kaspar Harsey.
And this has been Mo Mirzan.
And we'll catch you next week. Thank you.
Have we said the name of the podcast at all?
I said it in the start.
Oh, you did? Okay.
Yeah, this is Coverage and Coffee, by the way, in case you got this far.